Last week was brutal for enterprise software stocks. Salesforce reported that customers were delaying deals and closely scrutinizing budgets. As a result, Salesforce shares fell nearly 20% due to the weaker than expected outlook. Database provider MongoDB slashed its sales forecast, with the CEO stating everyone's kind of watching their pennies. MongoDB shares ended the week down over 30%. Other software providers like Snowflake, ServiceNow, and Paycom all saw declines of 10% or more. Really, across the board, software companies are reporting weaker than expected results. Additionally, these companies are lowering expectations that AI will rapidly boost sales and profits for the sector. So what is going on here? For a year now, NVIDIA has been reporting exceptional numbers as data center providers have been snapping up NVIDIA GPUs as quickly as they can be manufactured. Why hasn't this massive spending on hardware translated to software gains? And more importantly, will it ever? What is going on, investors? Hopefully you guys are doing well out there. Welcome back to the Bleeding Edge. So as you know, we're in the midst of a familiar technology pattern. One that begins with hardware, then it progresses to software. This leads eventually to the technology being everywhere. Hardware, software, everywhere. Similar to the personal computer era, where in the 70s and 80s, that paved the way for software giants like Microsoft and Adobe. The internet era saw Cisco and Motorola usher in Google and Amazon. Smartphones powered new applications like Uber. When we look back in a few years, a similar pattern will play out in artificial intelligence, but it doesn't mean it's going to happen overnight. As I read through the commentary from executives of software companies over the past week, a few common issues are slowing down the adoption of AI. First is competition. Companies like Google and Microsoft, they're engaged in a fierce battle to maintain the leadership position in their respective categories. Since rolling out AI features on Bing last year, Google has really frantically been trying to keep up with Microsoft, often rolling out AI features that are producing embarrassingly poor search results. And look, for Google, keeping pace with these innovative new features is outweighing the negative press that the company receives for the imperfect product. But that's not going to be the case for most companies. Financial institution, healthcare providers, schools and education centers, they can't suffer the same types of mistakes that Google can. Not only that, but most don't have competitors already producing and making groundbreaking AI products like Microsoft. So there's really no pressure for these organizations to rush anything to market like Google has to. The next hurdle with AI is the cost. These days, OpenAI is seen as a Goliath in the world of AI, with its popular ChatGPT product producing record-setting traffic levels even to this day. But just last year, OpenAI struck a deal with Microsoft for a $10 billion investment. But there's one very surprising aspect to this deal. Microsoft has wired over very little of this $10 billion investment in the form of cash. That's because instead of taking the investment in cash, OpenAI instead took the bulk of the investment in the form of cloud computing credits. The reality is running AI applications is far more expensive than traditional computing tasks. Most software providers that reported dismal earnings this last week cited that consumption-based pricing is keeping some customers on the sideline. Consumption-based pricing simply means charging companies based on the actual usage. So this variability and uncertainty of what the cost is going to be is making executives pause before they spend on fancy new AI features offered by the software makers. And the last thing, it's actually not something that these executives likely want to admit, but it's true. Most AI products that I'm seeing from existing enterprise software providers, they're just not innovative enough. Most software stocks have layered on AI to speed up certain tasks and provide recommendations. But that's not what the software phase of the technology revolution is all about. Look, spreadsheets and word processing software of the 70s and 80s, that was groundbreaking. Internet search engines of the 1990s, that changed how we found information. Uber and mapping applications changed how we traveled and found destinations using our smartphones. Salesforce adding an AI chatbot to its software isn't revolutionizing anything. But look, that doesn't mean AI is all hype. There is groundbreaking AI software coming. It just needs more time and, in reality, more money to be developed. Tesla's full self-driving software, a multitude of medical research projects that we've been looking at, and really industry-specific AI chatbots are in various forms of testing and production. So while last week it was harsh for these enterprise software stocks, it's clear we are witnessing a familiar technology evolution. This cycle is starting with hardware and it's progressing slowly through software and eventually everywhere. And it mirrors past technology advancements. Despite the current challenges such as fierce competition, high cost, and the need for truly innovative AI applications, the potential for AI to revolutionize industry still remains strong. But this transformation is going to take time. The cost of running AI application is significantly higher than traditional computing tasks. And this is going to lead to cautious adoption due to the consumption-based pricing models. For investors, for you, this gradual evolution is ideal. Costs will begin to come down and gradually more companies will begin to using AI tools more regularly. I suggest using this time and drop in many of the stocks in this sector to your advantage as the familiar cycle of technology is going to play out again. It's already started with hardware. It's slowly moving to software. Eventually, in a few years, we'll look around and it'll be everywhere. Folks, that was the Bleeding Edge for today. Be back later this week. Bye for now.